The following is a presentation of TFNN. Live at TFNN, the Power Trading Hour, with your host, David White. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, David White.
And welcome all to another wonderful day at the headquarters of technical trading and investing. It is TFNN.com. And we've got a day that will be interesting, to say the least. And we'll get right into it in just a second. Just take a quick look at the S&P, up 9 points, 2.1 billion shares. So we're up about 9 points on light volume compared to the last 2 or 3 days. And 2.1 billion shares. And of course, rocking and a-reeling a little bit from the Apple news last night, which we'll get into in just a second. In financial history, Global Crossing this day in 2002 went Chapter 11, if you remember those folks. And, of course, what a ride from the bottom to the top, back down to the bottom. And what a shooting star. But it was all about fiber optic cable, and it came and left almost immediately. Of course, they blew up because of John Bonds and Gary Winnick, who really fired the thing up in 1997. But actually had an attorney who used to work for them. He had all the paraphernalia in the wall, and he would have been probably close to worth about $500 million if the whole thing hadn't blown up. Meanwhile, he was an attorney and then actually had to become a real estate agent after that. A nice enough guy, got trapped in the wrong place at the wrong time. But what can you say? And of course, what we're really looking at today is the aftermath, what people in financial infotainment are calling the Hotel California. You can check into quantitative easing anytime you like, but you can never leave. And that's what we're looking at now. Overnight, we had, I think, the Fed step in, go after S&P treasuries, try to coordinate some good news and smiley faces, happy thoughts from those currencies and like South American ones that have been being rocked, a lot of third world ones. And they tried to stabilize them overnight. I suspect a great deal of what we have right now is the Fed trying to step in and stabilize what is going to be a long and painful process. I suspect that probably about the middle of the summer or early summer, whenever Ben Bernanke met with the president and told him that they were running out of time and that it was going to take action by the government, not by the Fed, to get out of this. And he probably recommended some things the government that the president didn't like, because he fired him a couple of days later unceremoniously on 60 Minutes. And my guess is that they've probably said, okay, we've done everything we can. Now you have to probably start dropping taxes. You probably have to do some pro-growth stuff. And he didn't want to hear any of it. And like I said, 2 days later, Sunday night, he was being fired on 60 Minutes without anybody really hearing anything more about it. Of course, now we've got Janet Yellen, and his last meeting is tomorrow. I don't know if he actually wanted to go on for another term. Hard to actually say, but very apparent from the leaks both in the White House and the president's tone that he's having none of it. He's in, like they say in Texas Hold'em, all in for the progressive view of higher taxes and more spending will solve it all. And, of course, no big surprise that actual employment rates haven't really changed that much. We've seen a huge decrease in the amount of people bothering to try to go to find work. And, of course, now the Fed has to even drop its rate even lower to make up for the gyrations of a government that always has the numbers, again, for happy thoughts. But a lot of Hotel California references today on many of the financial infotainment stations, CNBC, Bloomberg, Fox Business News, all on a similar theme. I bet somebody said something like that last night, and they've all been parroting it this morning. What a great album. And, of course, most people don't know, I've been to this place, that is not a hotel. You can check it out on Wikipedia. But what a great picture that was. What a great album. And it is the Hotel California, where you can never leave. But that's what everybody is speaking about today. That as soon as you start to exit, all these places that had massive amounts of cash come in, chasing monstrous kinds of returns, especially in the third world, are all now sucking wind. Almost every one of these governments decided that the money was so easy that they just spend like the interest rates would never go up around the world. And all you had to do was have just a little taste of that 3% on a 10-year. And it's enough to start places quaking. In fact, I think in Argentina, we're probably going to see the government fall within the next 30 days. Whether it becomes violent or not, unknown. But remember, in the Second World War, when everybody took off out of Germany, hiding, they all went to Argentina. Just give you a little idea about the prevailing views of a lot of people down there. I've got a friend that I've rode motorcycles with forever, and I can't get a word out of him about what happened down there. He won't talk about ever going back down there. All I can think of is something really bad happened, or he made it out with his life. Maybe his family didn't, but the guy will never talk about it. And you never know. A little different anyway. But anyway, today, Global Crossing in 2002. Today, it is quantitative easing in the spotlight. Of course, we've got the Fed out tomorrow. What is it? Just after lunch. And we'll be looking at that. But I'm pretty sure that we saw a coordinated effort last night to pull this market back. And especially without the market gapping down with Apple, makes me think that this is at least somewhat coordinated with the Fed. They didn't want, I think, a lot of movement before their announcement tomorrow. And it's pretty cheap to go in, and you can manipulate the market for a little while. You can go in there and buy a bunch of S&P futures and take a small tag. Since, of course, we don't know what they do, they won't let us know. And they say we're stupid if we ask because you don't want to know what's going on behind that curtain, Mr. Consumer. You're just not smart enough. You're just not in the know. We couldn't let the average U.S. taxpayer know exactly what's going on at the Fed. If you did, you'd probably shoot yourself or jump off a building. It's the only thing I can think. They're so worried about what we'll find out in there. And, of course, we've got a few congressmen pushing for at least some transparency, if not a little bit of opacity for the Fed. And right now we don't get a lot except very self-serving questions by congressmen and senators in the future. So, we're right around that 9.5 points up on the S&P cash. Volume is slow. I suspect it will go slow into tomorrow afternoon. But this is going to be at least one day of a bounce on light volume. I expect we'll probably see a little bit of that tomorrow. One of the reasons that we and the markets in general are going to have a problem pulling back is the Fed has to watch how fast this market pulls back. We've talked about it before, but I'll bring it up again for new listeners. In the debacle of 2007 and 2008, we had people that had no idea of the financial markets, like Barney Frank, decide that they wanted to have this Dodd-Frank bill. Part of it was the was a risk management quantifier, and part of that was known as value at risk. They put this in, and what value at risk is if you're a big hedge fund or if you're a big Wall Street banker or anything like that, there is a formula for figuring out how much risk and how much leverage you can have out at any one time. It's all good and well, but everybody operates on the same thing. And, of course, if they're going to allow you to have 30 times leverage, I'll guarantee you're going to have 30 times leverage all the time. Wall Street is leverage mad, because if something goes up, they will have left a lot of money on the table. And if something goes down, they just claim bankruptcy and ask to be bailed out again. Of course, privatizing profits and socializing losses. But the idea was to keep at least it down to a manageable level. The problem is that everybody went full tilt boogie. They're all at whatever the max leverages will allow them. Any pullback, any spike in the VIX instantly means that they have to start selling things to keep underneath the limit for value at risk. Just a move like we've seen the last couple of days may mean that they have to go from 30 times what they have to 28 times what they have in leverage. That means that 2 or 3% is going to have to be sold, and of course, if one person sells, the other person has to sell, and it can become a cascading effect that could actually crush the market. So, I believe the Fed came in last night mostly to make sure that even though and I think volatility will continue to rise over the coming months, that they just don't want it all to happen at one time, and the street itself. It has lots of shares of stock, and what it would like to do, we're coming up on window dressing for the end of the month. Hey, let's go ahead and shove a lot of those shares off to the people that buy every month in their 401k, whether they need to or not, in up markets and down markets. Of course, everybody's been been brilliant because the market's been going up. What we have to worry about is what happens on the way back down. Is it a house of cards? The Fed thinks it's bigger than the market. I think that they have a printing press as big as the market, but I don't think that they will outlast the market. So into snooze. When we were talking about all the things that can go wrong in the market, it is, I think I brought this up on Friday's show with Tom O'Brien. We were actually talking technology, but a lot of these things that happen are kind of tough to figure out, but they are well written about. And I got thrown in to full-time trading right around October, September of 1998. And, of course, that's right when long-term capital management blew up. It had to do with the Russian ruble and a big bet on that. They were buying huge amounts of treasuries. Anyway, everybody thought that they were smarter than the market. They got the smartest people in the room, always. And it all blew up on them. But when we come back, we'll talk about 3 books. You may want to take a look at any of these on Amazon.
Andy Hecht's powerful weekly newsletter, the Technomental Commodity Report, is going up in price again at the end of this month. Andy's weekly newsletter has delivered multiple profitable trades for his subscribers, even including a triple-digit winner within recent months. Right now is a perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy will also be hosting a subscriber event on Thursday, January 30th, Seasonality in Energy and Agricultural Commodities, that you can gain access to by simply signing up for a free trial to Andy Hecht's newsletter, the Technomental Commodity Report. A 30-day free trial to the Technomental Commodity Report, a free 60-minute live online webinar with Andy Hecht, which will be archived, and you lock in the low price of $49 a month should you decide to continue after your 30-day free trial. Offers don't get much better than this. Act now before January is over and this offer passes you by. Sign up for your 30-day free trial to the Technomental Commodity Report today.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different futures contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a 2-week free trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Dave takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
I don't know what happened. Maybe they're smoking some stuff, and maybe it was tainted. But I don't know what's going on in the studio. Ravi Shankar, and now this. They've got to be smoking dope. That's all I got to say. They are smoking dope.
What are you people? On dope?
No, I think they're on dope. That is true. Anyway, we were talking about books. One of the things, especially this time, since it's so much like 1998 in long-term capital management, wanted to bring up a few books. Probably ought to read one of those if you're going to be a long-term trader, especially in this environment. I read all 3 of them, mostly because I was getting beat up going full-time into a market and not have living through a whole issue with basically monetary issues blowing up all over the globe. But, of course, long-term capital management was leveraged at somewhere, last I remember, 110, 120 to 1, something like that, a ridiculous amount of leverage. Of course, they couldn't take any market going against them. The idea is if they just kept leveraging and leveraging, that eventually that they would become the market. They could decide the market. And, of course, that blew up rather spectacularly in their face. There's 3 books. One's called Paving Wall Street. Another one called When Genius Failed, probably the best of the three, but there's three different views of what was going on in it. And Inventing Money by Nicholas Dunbar. All three of these, I think, would be well worth your money to read. But it goes to show you that just because you're the smartest guy in the room doesn't always mean that you're going to end up with the cash in the stock market. It has a lot more to do with common sense than following Ito's machine gun formula. That's actually a real guy out there. And they went after his formula, Ito's formula, ITO. I programmed it. It's kind of an interesting kind of neat formula out there. But what can you say? But good reading out there. Last night on Tom O'Brien's show, he talked about a stock, and I think it was called Live, L-I-V-E. It's a symbol for it. And we were wondering whether or not it's one of these penny stock operations that just kind of took off and everybody got involved in it. And there is a website that you can take a look at. It's called stockpromoters.com. It's actually trying to advertise to these people of dubious, how can I say, dubious ethics in the stock market. And if you actually, I think I actually have the website up. If you actually plug in the ticker for it, in this case we're looking at Live, L-I-V-E, you can go in here and see it. Let me go ahead and zoom these up a little bit here. You can actually come up here and see who's promoting it, Wall Street, live chat, how much money that they were paid. It doesn't always tell you what it is, but it will tell you when they did it, the price range and the volume, when these guys did it. But you've got a lot of these websites that will take cash and or pay cash to go out there and pump stocks. So you might want to check that out if you want to see whether or not one of your stocks is being manipulated by one of these different websites, Penny Stock Rumors, Penny Whisperer. These all sound like great companies that only have your best interest in mind. Actual Gains, Bullseye Stocks, Penny Stocks. Anyway, there's according to them, they've got 10 years of data out here and lots of ads. But you can go back in here and look. But a little tougher to find out exactly who paid for what. But this company just advertises that they will run your operation if you want to become a penny stock player. But probably the best one to stay away from out here. But it looks like there's several websites that are involved in this. Probably one of the weirdest things that a lot of people haven't talked about in this new Wolf of Wall Street movies is just how active the mob was trying to get in to what they did. Not really mentioned in the movie at all. Now, we were talking about Apple. Don't have much time. I wanted to wait for a little larger segment, but we're going to get into a couple of charts of Apple and look at them. But probably the most interesting thing that came out last night, and that is IDC, the company that looks and finds market share data on big firms like Apple, seeing that Samsung smartphone share edged up 1% in the last 3 months, and Apple's fell a little more than 3.5%. I think that's pretty telling. So we'll be back in just a minute and get knee-deep into Apple. We're going to go in there and find the cores and the seeds and the stem in just a minute.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
Why don't we take a little piece of summer sky hanging on a tree? For that's the way to start to make a pretty world for you and for me. And for the sun we'll find a lemon bright.
Apparently, people in the short bus are running the station today. I apologize for having to listen to any of the bad stuff that they've played so far today. Of course, I've already figured a way to immune myself from them by listening to Jimi Hendrix. Probably about 30 seconds or a minute's enough to wash all that out of my head and get right back to everything else. I don't know what weird stuff he's playing today. Anyway, we were talking about Apple when we left. And it is they're losing market share. We talked about that. We talked about my call on September 29th. Basically, about $6.95 at Apple, saying that they had a problem. And I haven't heard anybody really bring this up. And this is why Apple is getting. I'm going to tell you why Apple is getting slaughtered, and why no one is willing to tell you what it is. They all have huge amounts of the shares of the stock, and they'd all like to sell it. So how do we figure this out, and why do they want to sell it? And I'll answer both those questions. First of all, I want to look at the technical side of Apple. Apple gapped down, got to 502.07 already today. And, of course, not a big surprise That is pretty much where you would expect it to go. I'm showing in Tiger TV and in the den right now the confluence level, which runs from 469 to 503.98. So we got right into it this morning. I'm not expecting it to bounce, to break through that on the first level. That is where it was expected to go. And, of course, you had a little bit of bounce out of it. Do I actually have a current quote on it? Yeah, 508.38. So, you've got a level of support that's going to be there for a while. You certainly have big stock manipulators like Icon in the stock. And, of course, here's what they're not going to be telling you. Let's go back one here, I guess. Let's go back to that one. That is that something I've been bringing up over and over again. Their smartphone business gives them somewhere between 50 and 65% margins on their product. The only other company out here that has anywhere close to 65% margins in hardware is Intel. It is a rare occurrence to find a company that can sell products with 65% margins. Now, here is the problem. Everybody's saying, well, they're going to come out with new products this year. How many other products will they run into where they can get 65% margins? They're only getting somewhere between 30 and 35% margins on the smartphones, which means that they have to sell 4 tablets for every smartphone to make the exact same amount of money. And that's what no one wants to get into. They fell into one of the most profitable businesses in the world. Just how many more profitable businesses like that are there in the world? The answer is very few. Intel has one where they can have 65% margins, sometimes as low as 59%. They're working very hard to carry what are almost thought of as software margins in hardware. And you can keep it up for a while, but even Intel and Apple, Apple a harder one because it's easier to go back and find a competitor like Samsung in consumer electronics. But how many let's say that they came out with a brand new Apple TV. Let's say the thing costs $1,000. Let's say it costs, $600 and some odd dollars to make. Well, they make $150 on it. They're going to be looking at 20, 25% margins on the thing. Not bad. In fact, very good if you were Sony. Very bad if you're Apple. They cannot take declining margins because of probably the difference between gasoline and rocket fuel. Just about that. Most companies run around with a little bit of gasoline. They're able to get a nice little bang for the buck. But the iPhone was rocket fuel. You got anywhere close to it, it was just shooting money out of the disk drives of the computers at Apple. It couldn't stop. It was like a printing press. Unfortunately, now they have more competition. It's several years into a market cycle, and Apple made the same exact decision that cost them the business in the 80s as it did this round. And what was it? At the very beginning of any market cycle, especially in consumer electronics, the mantra, especially in Silicon Valley, is just ship. Just ship, just ship. Get it out the door, just ship. And most products don't fail because they had a problem with it. Most products fail because the company fails to revise the product fast enough to keep up with the market. That is, you can come out with a product that isn't perfect. Microsoft does all the time. They came out with Windows, pretty horrible compared to the Mac at the time, and certainly the Amiga, which is the premier desktop operating system at the time. Unfortunately, run by a moron. I was involved in that side of it. So I've seen how companies go down south fairly quickly. But the point I'm getting to is there is that market cycle. The very beginning of it is ship as fast as possible. And one of the other mantras is you can have any color as long as you like black, which was Henry Ford, who probably was the first real technological purveyor of, I think he was probably the first one really figured out a lot of the rules of selling high technology in a car especially Model T, was high technology at the time, was to drive the cost down to where everybody can afford it, and we're going to sell boatloads, which was great. Ford started to dip years after the Model T, not because they weren't making a competitive product, but because they wouldn't change the color. All he wanted to do was do black. And, of course, in the iPhone, all Jobs wanted to do was white. He thought it was iconic. Where everybody had earbuds that were black, he wanted to make sure they were white, so people, when they wandered around, instantly knew and were saying, I've got an iPhone, I've got an iPad, I've got an iPod. Whatever it was, he wanted to make sure that they knew that it was his boutique product and not just an off-the-shelf wave player for $50 from one of the other multi-downstream players trying to make a few bucks on some memory and playing back some wave files. So what do we have? We get to a point in the market where the early adopters are done, and we start seeing other companies come in. It happened in the computer industry. There was a lot of early leaders. They failed to make the change. In this case, the change for Apple was not moving to bigger and higher resolution screens. They came out and said, we had the Retina display. Well, what was the Retina display? It was basically 254 dots per inch or 270 dots per inch, depending on who you listen to. So all it was a high resolution screen. Everybody loved it. Of course, Samsung came along and started offering 300, 350. Some of these out here now are 600 dot per inch. You don't hear Apple talking about Retina anymore. A lot of good advertisements on TV that pretty much destroyed the illusion of that. None so much as Amazon coming in and blowing the low end out of the market for tablets. But, of course, they didn't like the fact that that Apple didn't like the fact that everybody was, quote, quote, copying whatever they did. But also they didn't like, well, no one wants a 5 or 6 inch screen. I've heard that forever. And the answer is, if someone buys it, then yes, they do. And, of course, guess who buys 5 and 6 inch screens? Women who don't want to carry both a tablet and a phone. They've got a purse. They don't care about it. Guys, they're interested in smaller ones that fit in their pocket. Women, 54% of the population, they do care. They want something where they don't have to have both a tablet and a phone. So they buy what are known as phablets out here. And as their market share continues to decline, what happens? This is no different than the Macintosh. Steve Jobs, a lot of those people live in a bubble where everybody worships them, or at least they have enough customers that worship them, and it's very tough for them to go on. So just a little bit of marketing and high technology. You need to know when you've hit the crest of the market and when the early adopters are done buying, and you're now on the downside where margins are going to continue to go lower and lower and lower until it's a ubiquitous product. And I think probably the smartest player in all of this is Google. They are going with their Motorola product into the third world and trying to make the cheapest, most ubiquitous smartphone that's usable, but at the same time extremely cheap. And it's not a saturated marketplace. And I think probably a pretty smart idea. Maybe Samsung goes after that market too. But at this moment, Google, I think, has the only good idea that they've at least hit the top of that market in the bell curve. And now they're going on to the more pragmatic buyers, which is actually the term that they use in finance school. Anyway, when we look at Apple, it's come down. It's going to have monstrous volume. It's probably going to take a little time for it to wind up. And the answer is going to be whether Apple goes back to about 240, 280, is whether or not they can get a product that has big margins available. I don't think it's a smartwatch. I don't think it's Apple TV. They better have something in the books that can drive 50% margins if they want to keep going along. But very good idea of exactly where stock is going to. And I probably would have taken my money as it went to the logical place where Apple would go. And we've shown the GDX and the GDXJ. We've shown Apple here. This is a market that's going to work incredibly well with confluence levels. You better know them. In additional news out here, if you look at ESI and some of these other for-profit educational companies, they've been under fire. Of course, yesterday we found out that, let's see if I can get it here, ESI's, they're off $1 here today, which is about 2.6%. But they've all been under fire here for a while. The attorneys generals for more than a dozen states have ordered several for-profit education companies to turn over information on the firm's business practices. Looks like they've gone right back to what they were doing before, which is a lot of phony baloney loans that were never being able to be written off. Of course, we saw the turmoil that occurred with all the phony loans, and no one really that I know of went to jail on the deal. And I think because of that, they all think they're coming back to the trough and going to, like swine, going to eat away. But ITT, Corinthian Colleges, what's just COCO, Career Education Corp, Education Management, all disclosed on Friday and Monday that they'd received subpoenas for investigative demands for a group of state attorneys. My guess is that they're going to get right back into it. Of course, I brought up one of the best-looking shorts, and I am short it, and that is LOPE, L-O-P-E. L-O-P-E. And one of the reasons I went short was this beautiful looking top out here on no volume from last week. That was the January 22nd high. The most they could get out of there were 420,000 shares compared to the spike of 2.3 million shares on the October 30th high. I also like the way that the energy fell out from this huge move up, and just the total lack of volume from that December 12th low, even after we came back from Christmas, really didn't have anything. And I didn't know that there was something coming out, but I sure suspected. It looked to me like they were very interested in getting out of this thing, and probably a nice short. These confluence levels are actually kind of nice and wide, but I think we've got room for this one back down to the $37 level if the market does cooperate with me and go lower. But, you know, I really like it anytime you can test volume on half to look at it as a bottom or a top. When it tests it by a fourth, I have to put money on it. I can't just think that it's good. I have to act. And this was the one I acted on. But I think news is just going to get worse in this sector. And like I said, probably back in the 37s to the 34s is where support's going to come if there's any more bad news. What else do we have going on out here? Short interest on the NYC reported on Monday rose to 13.8 billion shares the first half of January from 13.4 billion shares on December 30th. That's a 3% increase, the biggest increase since mid-June of last year. So we are starting to see, and did see before this break, a lot of people getting short. And with that kind of percentage change, it was Wall Street. It wasn't me and you. It was me. But, I mean, I didn't probably make a dent in that level. When we come back, we're going to look at a lot of the stocks that are heavily shorted and talk about them for a few minutes. You can always give me a call at 877-927-6648. That's 877-927-6648.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try patterns, profits, and peace of mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's patterns, profits, and peace of mind.
And get the edge you've been looking for.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days, unconditionally, so there's no risk to you, other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Join Andy Hecht as he teaches you how to make money in commodities. The Commodities Hour, next on TFNN.
Don't hear any lead-in music. I think maybe they were trying to play Jaws because we were coming into Andy Hecht's next show. Normally we try to do that. That's late. Okay. But anyway, we do have Andy coming up in a minute. He was talking in the den about working for Merriman at Solomon, and maybe you'll have at least a few comments during the show about that. Of course, Merriman was part of the leadership of long-term capital management, and like a lot of stories, if you don't read it and you don't know your history, then you don't know what to really be afraid of on Wall Street, and you should. Now, what we do know is short interest has come out, and we should be aware of these stocks. Cliffs Natural, CLF, of course, it tried to actually rally out there. This thing is 34% short. Everybody hates it so much. You have to be very worried about it. Let's go ahead and look at, what is it? tried to think I had it here. What was it? CLF. Okay. Just make sure that I put it back in there correctly. CLF. Okay. And see if I draw it. There we go. Get today's data out here. Tried to rally today up to 2190, coming back off with heavy volume today. A lot of these stocks are just looking horrible. And if you want to talk about bearish looking charts out here, this certainly is it. There are a lot of these stocks that are highly short, and a few of them would probably offer a good move today. Lennar, D.H. Horton up a little bit today. Again, these are heavily shorted stocks, and between GameStop, CLF, Joy Global, Lennar, D.R. Horton, you should really be aware of these ones that have high short interest. Most of these ones are ones that I've talked about of being extremely weak. GameStop, I think, eventually going out of business in a couple of years. Other ones have actually dropped, probably still going out of business. But, you always see Sears there. You always see BlackBerry. And kind of interesting to start seeing some of these new ones on these highly shorted sides. But if we get a huge move out of here, maybe the Fed backs up all over a quantitative easing in the next day, you probably want to be looking at these stocks that are going to have a huge amount of natural buyers. I'd look at EA. I'd look at Expedia. I'd look at TripAdvisors. Always the usual suspects for a huge short squeeze out here. And what do we got? About a minute and a half left. Let's go back and to see what kind of volume we have left. It's volume very light still, 2.4 billion shares. So this is going to be one of the lightest days of the year for up volume yet again with a full day and, of course, midweek. I expect very light volume in the morning. And, of course, not uncommon to see a light volume bounce into the Fed. But my guess is we're not going to see anything different out of them this meeting, maybe next meeting. I think they're more than willing and coordinating with China to start looking at getting some of the excess out of this market. Of course, we talked about China last week before anything really happened and the problems with their wealth management funds. And how they were starting to come in. And, of course, that was probably about 2 days ahead of the market catching up with the news on that. But there is more than enough out here that makes me think that the Fed and even the bigger countries out there like China are more than willing to come out and start letting a little bit of the steam out of this market. Ooh, here comes Andy. Let's talk about long-term capital management, Andy. Real sharks. Real sharks. Anyway, sell when you can, not when you have to. See you tomorrow.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.